Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at BigBear.ai Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine looking at a quarterly earnings report, right? And you see that nearly 40% of a company's revenue has just, well, it's seemingly vanished into thin air.
Right, which is usually a terrifying thing to see.
Exactly. For most investors, that is an immediate, flashing red signal to just liquidate your positions and walk away.
Ugh.
But instead of panicking, Wall Street analysts are actually quietly projecting a massive 52% upside for this exact stock.
Yeah, there's a huge disconnect right now between the headline numbers and the underlying business model.
It's wild. So today we are doing a deep dive into the source material on BigBear.ai Holdings because they are right in the middle of this high-stakes structural pivot. And our mission today is to really dissect whether this recent revenue contraction is a fundamental breakdown or if the market has just drastically mispriced what could be a massive wealth-building entry point.
Right, because when a company undergoes a total restructuring like this, the surface-level metrics often completely mask the actual mechanics of the business. I mean, you just cannot evaluate a company in transition by looking solely at top-line revenue from a single quarter.
Because it's just a snapshot in time.
Exactly. You really have to examine the balance sheet, the underlying strategy, and, look at the capital deployment that sets up the next 2 years.
So let's start with the most glaring contradiction in the numbers then, because we really can't look at the upside until we understand the damage. We have the Q4 2025 earnings. Break down what actually happened here, because, a 38% drop is severe.
It is severe, yeah. The top-line damage is a 38% contraction in Q4 2025 revenue, which brought the total down to $27.3 million. But we really have to look at the mechanics driving that number.
Right. It didn't just happen in a vacuum.
No, not at all. The contraction is actually the result of two massive forces colliding at the exact same time. And the first force was entirely planned. The company intentionally chose not to renew several of their legacy high-margin government contracts.
Wait, intentionally?
Yes, intentionally. They are actively phasing out older, less scalable frameworks so they can transition their entire revenue model toward highly scalable AI platforms.
Okay, I have to challenge that narrative right away on behalf of everyone listening. Because if you are projecting full year 2026 revenue between $135 million and $165 million.
Which is about 17% growth at the midpoint, right?
17% growth compared to 2025's full year. Why on earth would you intentionally shed high-margin revenue to get there? That sounds like, taking 3 steps back to take 1 step forward. It's incredibly easy for management to claim a massive revenue miss was intentional after the fact.
That is a very fair pushback, but it really comes down to resource allocation. Look, supporting legacy government software requires massive human capital. You have to dedicate whole teams of engineers to maintain these outdated code bases.
Which means they're tied up.
Exactly. It prevents those exact same engineers from developing the high-margin, highly scalable enterprise AI software that actually drives long-term growth. So they are essentially trading static, resource-heavy revenue today for scalable, lower overhead revenue tomorrow.
Okay, I see. But you mentioned 2 forces. What was the second one?
Right. So the second force driving that 38% drop was definitely not planned, and that was the macro environment, specifically the longest government shutdown in history.
Right. But let's get into the weeds on how that actually impacts a balance sheet, because I think people assume that when the government shuts down, defense contractors just, they get their checks a few weeks late.
Oh, it is so much more destructive than just a delayed check. In federal contracting, the Department of Defense doesn't simply wire a company a lump sum at the start of the year. They issue specific task orders against a broader contract.
Okay, so it's piecemeal.
Yes. So when the federal government shuts down, the procurement officers are furloughed, task orders cannot be legally issued, and work legally has to stop. So if you're a contractor relying on billable hours, those hours are completely permanently lost.
Wow. So you can't just make them up later.
No, you can't. The overhead remains, the staff remains, but the recognizable revenue for that entire period just vaporizes.
So the Q4 numbers essentially reflect a company simultaneously trying to pivot its entire business model while having its primary customer legally prohibited from buying its services.
That's exactly it.
Okay, that definitely explains the drop. But look, a 38% hit to the top line usually triggers a massive liquidity crisis for a tech firm of this size. How do they actually survive that kind of shock without going bankrupt?
They survived because they spent the previous 12 months systematically building what is basically a fortress balance sheet. BigBear.ai Holdings closed out 2025 sitting on $462 million in total cash and investments.
Wait, 462 million?
Yes. They went into that government shutdown with the highest cash reserves in the company's entire history.
That is a massive buffer. But, cash only tells half the story if a company's drowning in debt. What does the liability side of the ledger look like?
The liability side is really where the true restructuring occurred. While they were navigating this revenue contraction, they successfully executed a staggering 90% reduction in total debt.
90%? That's huge.
It's massive. The major catalyst for this was in January 2026, when they settled the remaining $125 million of their 2029 convertible notes.
Okay, I want to spend a minute on this because understanding a debt-to-equity conversion is, I think, super crucial to understanding the institutional psychology around this stock.
Absolutely.
Because a convertible note basically means an institution loaned the company money, but they hold the option to take stock in the company instead of a cash repayment if the conditions are right. So for them to settle $125 million primarily through debt-to-equity conversions, right, while the company's revenue was dropping 38%, that is a massive signal.
The mechanics of that decision are incredibly telling. Look, note holders are notoriously risk-averse. If they genuinely believed the revenue drop was fatal, they would have demanded their cash back.
Right. They'd take the money and run.
Exactly. They would have forced the company into highly dilutive financing or pushed them toward restructuring. But by choosing to convert that debt into equity, those institutional lenders are explicitly stating that they believe the underlying equity of the company is ultimately worth significantly more than the guaranteed interest payments on the debt.
So to use an analogy, the bankers essentially tore up the IOUs in exchange for a piece of the company. The bankers became owners.
That is a perfect way to look at it.
And that fundamentally shifts the risk profile for the everyday investors listening right now. Because that constant threat of a massive, highly dilutive stock offering just to keep the lights on, that's been neutralized. Institutional stakeholders now have a massive vested interest in the stock price going up. Their goals are perfectly aligned with the common shareholder.
And crucially, that debt-to-equity conversion frees up that $462 million in cash to be used exclusively as offensive capital rather than defensive life support.
Oh, right, because they aren't servicing debt anymore.
Exactly. They no longer have to stockpile cash for debt payments, which means they can deploy it to actively acquire the technology they need to hit that projected 17% growth target for 2026.
So let's talk about how they are deploying that capital. Because now that we know they have almost $500 million in cash and virtually no debt, they've been on this highly strategic shopping spree, right, to build out their core competitive moat.
Yes, they call this moat decision intelligence for the defense and logistics sectors. And operating in the defense sector requires clearing massive barriers to entry.
Like security clearances, I imagine.
These security clearances, the ability to integrate into decades-old legacy military systems, and you have to prove airtight, impenetrable security at the data layer. So to accelerate their dominance there, they made two highly specific acquisitions. The first is a platform called Ask Sage.
Ask Sage. Okay, what does that do?
It's a secure generative AI distribution platform.
But, there are literally hundreds of generative AI platforms flooding the market right now. What makes Ask Sage worth acquiring?
Because Ask Sage solves the single biggest fear keeping Department of Defense procurement officers awake at night vendor lock-in.
Ah.
Yeah. Ask Sage is fundamentally model-agnostic. It is not tied to one specific tech giant's large language model.
This is such a critical concept to grasp. It's essentially the Switzerland of AI. If the U.S. military builds their entire logistics infrastructure around one specific Silicon Valley tech giant's AI, and then 2 years from now, a competing company builds a drastically superior model, the military is trapped.
Right. Tearing out the old architecture and replacing it would cost billions, and it would completely compromise security.
Exactly. So Ask Sage prevents that.
Precisely. Ask Sage acts as a secure intermediary layer. The client builds their security protocols and user interfaces on the Ask Sage platform. Then, on the back end, they can plug in whatever AI model is currently the best in the world.
So no vendor lock-in.
None. If a better model comes out next week, they simply swap it out on the back end without having to rebuild their entire secure network. BigBear.ai Holdings is positioning itself not as the creator of the AI, but as the neutral, secure router that allows the government to safely consume multiple different AI models.
That model-agnostic approach is brilliant because it removes the risk of betting on the wrong AI developer. Now, the second acquisition they closed in January 2026 is a platform called CargoSeer. How does that fit into this decision intelligence ecosystem?
Oh, CargoSeer brings a proprietary computer vision layer into their supply chain security offerings. You can think of it as the physical complement to AskSage's digital processing.
Okay, let's put a real-world use case on that. What does a computer vision layer actually look like in a military supply chain?
Think about the movement of critical military assets, like, say, specialized drone parts. Digital ledgers and shipping manifests can be hacked or spoofed by state-sponsored actors to show that a shipment has arrived when it actually hasn't.
Which is a massive security risk.
Huge. So CargoSeer uses computer vision, literally physical cameras and sensors at the loading dock to scan serial numbers, verify crate dimensions, and cross-reference the physical reality of the shipment against the digital ledger. It ensures absolute physical chain of custody.
So AskSage processes the intelligence, and CargoSeer verifies the physical reality of the logistics.
Exactly.
Combining those two capabilities, backed by nearly $500 million in cash, gives a very clear roadmap to how they plan to achieve that $135 to $165 million revenue guidance. But I have to bring us back to a massive structural vulnerability we highlighted earlier.
The government shutdown.
Yes, their Q4 was decimated because they rely so heavily on the U.S. government. How does a company protect itself from future gridlock in Washington?
That single point of failure is arguably the biggest risk to their entire thesis, and management is addressing it right now through aggressive geographic diversification. They are pushing heavily into the Middle East, specifically setting up operations in Abu Dhabi in the United Arab Emirates.
Establishing operations in the UAE is a very different game than bidding on DoD contracts in Washington. Are they, building the infrastructure themselves from scratch?
No, no. They are entering through strategic partnerships with established local entities, specifically Vigilix and EasyLease.
Okay, so they have local partners.
Right. And the UAE is currently executing this massive $1.4 trillion investment framework centered heavily around smart cities, independent supply chains, and advanced logistics.
Wow, 1.4 trillion.
It's massive. By partnering with companies like EasyLease, which already has deep roots in the region's physical infrastructure, BigBear.ai Holdings can just layer their AI and computer vision software over an existing network. It is a highly calculated move to tap into massive capital pools that are completely detached from the volatile, politicized budget cycles of the U.S. Congress.
Geopolitical diversification is smart, definitely. But let's see if the market actually believes this strategy. I want to look at the technical trading action with you because the numbers are fascinating right now. As of early April 2026, the stock is trading right around $3.58.
Right. And the initial reaction to the Q4 earnings was predictably cautious. The stock experienced a pullback of about 7% as algorithmic traders and, headline readers reacted to the 38% revenue contraction.
But the selling pressure was completely absorbed. Over a recent 5-day stretch, we saw a positive 4.68% change. Dip buyers are aggressively stepping in at these levels. But the single most compelling data point I found is an updated analyst projection. An analyst recently came out and actually decreased their price target on the stock by 15.79%. They lowered the target down to $5.44.
And typically, when you see a price target reduction of nearly 16%, the market interprets it as a deeply negative catalyst. It usually signals fundamental weakness.
Right. But look at the actual math of that downgrade with me.
Mm.
A lowered target of $5.44 sounds like bad news in a headline. But if the stock is sitting at $3.58 right now, that downgraded target still implies a massive 52% upside.
It does.
The market is pricing the stock like it is going bankrupt. But the analysts, even while tempering their expectations due to the Q4 miss, are still modeling a 52% rally. Are analysts basically saying this current price is a blue sky entry point disguised as a sell-off?
The analyst math reflects the reality of the balance sheet. When analysts see a company trading at a microcap valuation but sitting on $462 million in cash and zero immediate debt obligations, they recognize that the downside risk is severely capped.
The baseline floor of the company's value is insulated by that huge cash pile.
Exactly. The 52% upside is simply modeling a return to standard growth valuations once the market realizes the restructuring is actually complete.
So we have laid out a very compelling wealth-building thesis here. A cash-rich company, debt cleared out, highly specialized AI acquisitions, and massive implied upside. But our job is to responsibly stress test this. What is the actual bear case here? What breaks this thesis? And exactly when will the market know if management is actually pulling this off?
Okay, the primary bear case centers entirely on execution risk,
Yeah.
specifically software integration.
Which is never as easy as it sounds.
Never. It is very easy to write a check to acquire Ask Sage and CargoSeer. It is exponentially more difficult to integrate a generative AI platform and a proprietary computer vision layer into a cohesive, functioning ecosystem that legacy defense clients actually want to use.
Right, mergers and acquisitions are just notorious for technical friction.
Exactly. If the engineering teams cannot get the various software architectures to communicate flawlessly, the cross-selling synergies will completely fail to materialize.
And if they fail to integrate the tech smoothly, the stock will stagnate. They just burned a massive amount of their cash pile on disconnected tools. Plus, despite the UAE expansion, they are still overwhelmingly reliant on the U.S. Department of Defense right now. Geographic diversification takes years to fully reflect on the balance sheet. So what is the specific timeline investors need to watch?
The absolute critical proof of concept quarter will be the Q1 2026 earnings report, which is slated for late May or early June. The market is going to demand hard evidence that the revenue contraction has stabilized.
They need to see cross-selling momentum.
Yes, they need to show that the non-recurrence of the legacy contracts is fully absorbed, and they need to show initial revenue traction from the new AI platforms. If Q1 shows further contraction, the stock will likely retest its lows regardless of the cash pile.
Okay, let's zoom out and factor in the macroeconomic environment. Are there broader market forces acting as tailwinds for the stock over the next 6 to 12 months, even if the Q1 numbers are just, mediocre?
There are two significant macroeconomic catalysts in play. First, the broader market is closely watching the Federal Reserve for potential rate cuts later in 2026.
Right, and rate cuts fundamentally change the math for high-growth, high-beta tech stocks.
Absolutely. When the cost of capital drops, the present value of a company's future cash flows increases, which historically drives aggressive rotation into stocks exactly like this one.
A lower interest rate environment heavily rewards companies that prioritize future scalability over immediate profitability. What is the second macro catalyst?
The typical seasonality of defense spending. Historically, the Department of Defense budget cycle results in a heavy concentration of finalized contracts and increased spending in the second half of the fiscal year.
Use it or lose it.
Exactly. As procurement officers rush to allocate their annual budgets before they expire, companies positioned with highly relevant proved technology tend to see a surge in late-year task orders.
So, synthesizing everything we have discussed, the massive Q4 revenue hit, the $462 million fortress balance sheet, the debt-to-equity conversions, the model-agnostic AI strategy, and the execution risk. What is your final evaluation?
Factoring in the risk-reward ratio, I assign this a bullish score of 7 out of 10.
A 7 out of 10. Okay.
Yeah. The fundamental transformation of the balance sheet provides a really unique safety net, but the execution risk of integrating new acquisitions restrains the score from being higher. In terms of an investment horizon, this is strictly a medium-term hold. You need a 6 to 12-month window to allow the Q1 and Q2 earnings reports to fully validate the growth narrative and prove the integration is successful.
That makes perfect sense. So let's tie this all together for you, the listener. We are analyzing a company that took a brutal 38% revenue punch to the chin, but they used the chaos to orchestrate a complete masterclass in restructuring. BigBear.ai Holdings has mutated from a risky, debt-laden microcap into a cash-rich, strategic consolidator ready for the AI defense boom. They wiped out their debt by convincing their lenders to become owners, and they bought the exact technology required to act as the neutral, secure ground for government AI adoption. If management can execute the integration smoothly, that 52% upside projected by analysts might actually be incredibly conservative.
It really could be.
I'll leave you with a broader strategic concept to analyze within your own investments. Right now, everyone is obsessed with which company will build the smartest, most powerful AI model. But if BigBear.ai's model-agnostic strategy works, it suggests the real winners of the AI revolution might not be the gold miners, but the companies building the secure vaults to hold the gold. Look at your own portfolio. Are you only betting on the AI creators, or are you also investing in the secure intermediaries that make that AI safe to use in the real world?